All right, guys. This is an example of how do you find stocks, and I mean, there's a million different ways. Some people might look at return on investment. Some people might look at free cash flow. Some people might look at dividend growth. Um, there's all sorts of things, but um, from a value perspective, a value investing perspective, um, basically, price to book means that the company's assets is selling for less than the company is worth. Let's say the company's assets are maybe 100. Let's just keep it small to keep it simple. Let's say the assets are $100 million, but the company is trading at $80 million. And like I said, a lot of times some of these companies they just came out of bankruptcy. Maybe they had a lot of bad news. Maybe one of the CEOs or high-ranking officials was caught in a scandal or said something that they shouldn't have said. Um, there's any number of reasons, but just doing that search, price to book, and like I said, you're not going to find the Buffett. Started looking for cigar butts when he started, where you could get one puff at them and get maybe a 20% return or whatever, and then get out of them. But I guess as he got older, he decided it was better to just buy great businesses at fair prices and keep them for forever. And so a lot of the times when you find these cigar butts, they're not going to be the premium companies. Now, every once in a while, like I don't particularly like Facebook or anything. I use Facebook, but I wouldn't invest. That's just my personal opinion. But when it dropped 90%, I mean that might have been a good time to buy. So I mean, sometimes a great company, a great business, will have buying opportunities. I mentioned Berkshire Hathaway a couple years ago when it was like $170 a share, and now it's like, I don't know, $350 or something. But you can do searches through whatever means you want. I mean, me personally, I like low PE. And the reason is, let's say the PE is 2. Let's say, crap. Oops. Well, anyway, let's just say the PE is 2. Well, the inverse of that is 50%. So, I mean, basically you'd get 50% year 1, 50% year 2. You get your money back in 2 years. And let's say you hold the company for 10 years. You get your initial investment back after 2 years. And then you have 8 years of profit. Or however long you hold it. You can hold it forever. So, I mean, the company, hold it for 40 years, you would have 38 years of profit. But like I said, a lot of times these are not great businesses. They're not great companies. Um, Me personally, I don't really. I kind of stay away from biotech. I kind of stay away from financials. Um, that's just me. Um, I like a lot of foreign companies, and the reason why is because I believe that things in the U.S. are overpriced, and yeah, I mean there's some deals to be had in the U.S. market, but I believe it's more deals in other countries, and that's my personal opinion. I mean, Buffett, for example, I mean he mainly just strictly buys U.S. companies, and that's not always true, but I mean for the most part. Uh, but I would much rather um, invest in. Let me see if I can find one that I had actually um, purchased. I can't find it right now, but anyway, like I was going to use like lumber for example. Like if they produce lumber or they produce steel or they do chemicals or they make they do plastics. They make some product. Um, so I would prefer those. That's just my personal opinion. The reason I kind of stay away from biotech is, yeah, they can shoot up like crazy. Let's say you invest in a company and they make the new cancer drug or something, and the way biotech companies work in theory is, they spend a whole lot of money on research and development for many years, and then they hit a miracle drug or they make a breakthrough, and then they can charge top dollar for so many years. I don't know what it is now. Let's just say it's 10 years. They can charge top dollar, and then at the end of those 10 years, then they other companies can make a generic version or whatever and sell it for really cheap. Um, but basically, those years that they get to charge a premium is allows them to recoup all those years of research and development. And not only that, they can also be sued. Um, and some drugs, it's years later that they find out something's wrong with it or it caused cancer. Or so, um, I don't know. Like a company that has a low input cost. Let's use chocolate candy for example. Like if you make, let's say, candy and you give it to your girlfriend for Valentine's Day, and she really likes that candy. Well, next year you better get her that chocolate candy, or you're not going to get a kiss for on your wedding anniversary or her birthday or whatever. And so like candy companies, like they can increase the price every year, but yet the cost of them making that candy really doesn't go up that much. I mean, yeah, it might go up a little bit, but if you know your wife loves a particular jewelry or something, I mean, they could they could keep you get a bracelet or something every year, and they could even keep increasing the price. With razors, they just you really only need one blade, but they just kept adding more and more blades to, I don't know, charge more money. But yeah, this is one way you can find potentially value stocks. Like some of them might be value traps. I mean, and you might be totally wrong, and that's okay. You don't need to be right on everything. But basically, what a price to book less than one. Let's say it was trading at. Let's say it was at 1.2 or something. That would mean that you're paying a premium of 20% higher than what the assets are worth. Sometimes, like I was saying, in the case with Sears, for example, I mean, they might have bought the farmland or something for $5,000, and then, fast forward 100 years into the future, that land is worth a lot more than $5,000. So sometimes the assets are not accurately priced, and this is one good reason, one way that the diligent investor can find bargains. And so anyway, thank you for listening.